Welcome back to the show. Well, this is actually a great conversation. It ties into our earlier conversation with Alex Norro from the Ottawa Food Bank and how difficult it has been when you look at inflation. And of course, we just had another rise in interest rates. And here to tell us, the effects that that's having in one of the latest polls that they've done, I'm joined by John Hrolovich. He is a licensed insolvency trustee and senior vice president over at MNP Limited. Welcome, John. Great to have you in person here in studio.
Yes, thank you for having me.
Let's talk about this interest rate. I mean, the results of your latest poll, what have you seen?
Well, key takeaways from the poll is now 84% of individuals are very conscious that interest rate are happening and those increases are impacting them on their day-to-day spending. And about 60% of those individuals are saying that there is a direct impact on their budget. And that is becoming very noticeable with Ontario individuals that we surveyed through our latest poll.
Yeah, and I think a lot of people have a hard time, John, wrapping their head around, okay, interest rates go up, that is supposed to help inflation, but then we look at food inflation, it doesn't seem to be having an effect. I don't know if you can answer this question, but why do we play with interest rates in this way? Does it really affect inflation? Is it effective?
Well, it is there to try to curb some of the spending. So at lower interest rates, keeping up with the Joneses kind of scenarios happen where individuals are able to spend more money, but realistically down the road, interest rates increases are helping to stem that so that people can try to stay within their budget. The impact is the increases we've had have been very dramatic over the last year, and that impact and change hasn't given consumers, I don't think, enough time to adjust their budgets. So the impact on this would be longer lasting than just the last 6 months. I think we have to look years out on how that's going to affect individuals.
Well, yeah, talk a little bit about that, because if somebody got, maybe a 5-year fixed rate at 2.5% a few years back, what's that effect going to look like?
Right. Many of us took advantage of those low interest rates and locked into 5-year mortgages or even longer terms. When those renewals come up, they have to readjust their spending based on current interest rates that are in force at the time. That's going to have a dramatic increase on some individuals' budgets, because if interest rates have doubled since they locked in, well, that is going to be an extra $100 or $200 a month out of their budget to cover interest rate increases that they weren't expecting when they first did those mortgages or made those purchases. So the impact from today's interest rates or last week's increase won't really be seen, I don't think, until 2 or 3 years from now. So we have to keep an eye on that.
Well, what can we do now then? What do you suggest when it comes to small changes people can make in their budget?
Simple tools that you can do in your budget. You can look at subscription costs, for example. You can reduce those if you're not using them. For example, a gym membership. I know it feels good to see a gym membership expense come out on your credit card, but if you're not going, maybe you should just end that subscription.
Right.
A lot of people carry different types of services for TV and cable. Maybe pick your favorite, eliminate the other two, and then look at your budget. So when you look at a budget, you have some money allocated to living costs, food costs, and then you have your discretionary spending where you make a choice. And that's where you have to really look at your budget and say, in my discretionary spending money, where I have the ability to change my course, do I have room to eliminate some of these things so I can free up and cover increases in food and other interest costs that are being passed down to consumers?
Another one I think caught my eye, and we were just talking about it. I said I'm guilty of this. Let's say you get a new cell phone, they offer you a free trial of a streaming service. You have to be careful of when that trial ends, because sometimes it's sort of forgotten, right? And keeping track of that sort of thing is important as well.
Right, and a lot of those incentives, nothing is really free. At the end, they're front end loaded for freeness, and at the back end you pay an extra cost. So you've got to keep your eye on that, because that again will be an unexpected increase in your day-to-day living. So you've got to do a reminder in your phone or calendar or something that says to you, I've got to look at this cell phone bill because it's coming up for renewal, and what can I do? Can I accept that charge, or should I look at downgrading my coverage type of, the data plan, whatever is part of that cell phone, and look at ways to make it more cost effective.
What is the debt that we should be paying off first and foremost when we look at our budgets?
Well, the most logical debt to pay off is the highest interest rate. So
right.
Whatever debt you have in today's world, it's credit cards. So if you have a mortgage at 2.5% that you've locked in, I wouldn't be accelerating my payments on my mortgage. I would be looking at trying to cover off higher interest rate debt that you may have, either car loans, credit cards, or non-secured loans that have much higher interest rates. If you can accelerate repayment on those, that's where I would focus my money if it's in your budget.
When should we be concerned? Like, what's the big red flag for me where I'm falling in so much debt that I need help?
Right. So consumers should start to be concerned is when they look at the amount of money they have available to service debt. If that number is shrinking, they should be trying to, and they can't change their budget, they should be trying to reach out to someone like myself, like a licensed insolvency trustee, where we can sit down with you, the consultations are free, and see whether there are things we can do to help service your debt that over the long term, next 5 years, can make things easier for you to weather maybe a potential increase in your mortgage payments when those come up. We can sit there and help you try to figure out a solution to that process.
So is that what you would refer to as a consumer proposal?
Consumer proposal is one of the options that we offer at our firm.
What does that look like? What is a consumer proposal?
So a consumer proposal is basically a negotiated agreement between you and your creditors of some type of repayment plan that typically goes to a maximum of 5 years. What I conceptually say is it freezes the debt. There's no further interest being allocated to that debt, and every payment you make towards your consumer proposal is reducing your debt. So you're getting closer and closer to being debt-free. And at the end of the 5-year term, or sooner if you can pay it off earlier, that debt is all gone. And that's a great advantage to most consumers. If they're really tight right now on their budgeting and don't have a lot of wiggle room to service debt, that's a viable option for them.
Quickly, John, so what are the other options then?
Another option they can have is a straight bankruptcy option, which eliminates the debt. The terms are a little bit different than a consumer proposal. The impact to credit rating has a little bit more direct impact going forward. So we look at that as professionals, and one of the only ones that are governed by the Government of Canada as being licensed insolvency trustees. We'll look at the options, share that with the individuals, and then allow them to make the choice of what is best for them.
Right. And it's a scary word. People don't like hearing that word, but you can bring yourself out of it. And, people should take comfort in that if it ever comes to that. John, thanks so much for joining us. Really appreciate your time today. Don't go anywhere. We'll be back with more Daytime Ottawa right after this.